answering your questions about retirement. It's Money Talk with Michael Eastham.
I still have 6 years before I plan to retire. Shouldn't I stay in the market longer to get better returns rather than shifting to more conservative income investments?
6 years might seem like a long time before you actually retire, but it's not as long as you might think. And the problem with your thought process there is if you don't have a crystal ball that's going to tell you exactly when the market's going to be up and when the market's going to be down, you may end up in a bad situation when you actually want to retire. Think about it for a second. If you're invested for growth, in other words, you're invested in things that you want to buy low and sell high, well, what happens if you buy low and then when you need to sell it, it's even lower? That means you're going to incur losses. If you're retired and you need that money for income, that's a problem. You're going to end up spending principal and you may end up running out of money too soon. I'm a much better advocate of repositioning money, especially 5 or 6 years is right in that time frame. I tell people that red zone of retirement is 10 years from retirement. You want to start to evaluate your investments, begin to reduce the risk, make sure that your interest and dividends from your investments are covering your income needs so that you don't have to sell any investments to cover your expenses, to cover the travel, the things that you really want to do when you retire. The other issue that I want to make sure that you understand is that when the stock market drops, and we have significant drops like it did in the year 2000 with the tech crisis, like it did in 2008 with the financial crisis, it took close to 7 years for the market to recover. You're going to retire in 6 years. What if you're right on the front end of that drop and you're ready to retire? Well, the market may not come back by the time you want to retire. So then you're going to have to ask yourself some really hard questions. If the market drops by 50% and you've got $1 million saved up, well, now you only have $500,000. That's a very different retirement than if you had $1 million. So think about the way that you have your investments, think about your income needs, and let's see if we can determine what the right allocation is so that your interest and dividends is paying for your income. That way you don't have to worry so much about whether the market is up or down. Hope that helps, but please reach out and I'll be happy to go into a lot more detail to make sure that you've got that allocation that's designed to set you up for a stress-free retirement. Thanks so much.
If you've got a financial question you'd like to have answered, click on the link below to submit your question. You may hear your answer on an upcoming edition of Money Talk.